Welcome to this Killick Explains video, and this week I want to take on something which is quite topical, and that is how to make an effective financial gift. Now, who might be the fortunate recipient of a gift? Well, lots of young people. Lower generations of families are pretty much up against it. Property prices seem to keep rising. Mortgage costs, of course, have gone up recently. Scrambling around to get a deposit together seems to get tougher than ever. Meanwhile, pensions are gradually being whittled away, and that is to say that the old style final salary schemes are kind of a thing of the past these days. People are having to save harder and longer. And of course, state support for young people is being chipped back, whether in the form of the minimum pension age, whether in the form of help with university fees, and so on. So, naturally, quite a few grandparents and parents, if they can afford to, are quite keen to help out, or maybe keen to help out, and wondering how to go about it. Now, I'm going to cover 4 gifting rules here. There are more. So essentially, I think the structure for making a decision, as say a grandparent or parent, about should we and can we help younger generations of the same family, let's say, or help anyone else for that matter, they are, number 1, can I afford to do it? I'll come back to these. Number 2, how am I going to do it? In what format, if you like? Number 3, am I going to do it early enough? And I'll mention all of these again in a moment. And number 4, have I thought about the tax implications, or have I at least considered how I can bring down the tax bill or any tax associated? So affordability first. Affordability is all about making sure you put your own life vest on, as I tend to call it. In other words, there's no point as a grandparent or a parent in making a gift down the generations, if you like, only even years later to then have to call it back, all right? Because that makes it very difficult for the person who receives it to plan their life, if you like, thinking, well, do I need to keep some of it back? And also, it's not a very good idea from a tax point of view, without going into the detail straight away, to have assets passing back up family generations having gone the other way, all right? So also on affordability, make sure you're aware of the specific rules. So, can I afford to do it on a sort of macro level, but then drilling down. For example, if you're going to make a regular gift out of income, as it's called, which is what it sounds like, going to give money on a regular basis to a child, for argument's sake, if you want that to be inheritance tax efficient, for example, it needs to meet the specific rules on affordability that attach to what are called gifts out of income. So there's the kind of big picture, can I afford it? And then there's, have I looked at the relevant rules just to make sure none of them will catch me out later. Next then, so that's affordability. How am I going to do it? Now, the obvious way to make a gift is cash. It's the simplest, cleanest way, and that's because HMRC generally assume that cash you've got in a bank account has been taxed already. Because you must have earned it, it would have been taxed. Maybe you sold something, it would have been taxed. All right, so in many ways, it's the most straightforward gift. But, of course, if you hand cash over to somebody, you lose control. All right, now, there are other things you can hand down, property, for example, shares, and there are quite a few different implications to making those choices, but you've got to weigh up. If I make the gift straight away, am I worried about the fact that I then lose control over it subsequently? And, what format would the gift be most reasonably made in? For families who can afford to do so, am I better off giving someone cash that they could put towards a property, or am I in the luxurious position of maybe being able to gift a property, for argument's sake? And again, with shares, how are you going to actually make the transition of wealth from one generation to another? All right, so make sure you look at, can I transfer it? Who's it going to go to? And should it be, for example, protected by something like a trust? Because what a trust can do is it can make sure that assets pass through the generations, but maybe control isn't taken by, say, young people until they reach a minimum age. And that age with a trust could be 18, could be 30, could be higher. All right. Finally, be careful of what I call partial gifts. If you're going to make a gift, you do have to give up control. You've got to be comfortable with that. Because if you do what I call a partial gift, or you retain a benefit, so a simple example might be you take some benefit from the cash that you've handed over to someone else in the family, then HMRC might later come back and say, actually, was that a bona fide gift, or was it something else like a loan, for example. So just be careful there. Timing is another issue, and then we'll do tax last. So with timing, you've got to think about who's going to benefit from the gift and how's it going to be done. For example, are you looking to pay school fees as a lump sum up front in the hope of reducing the overall cost if you can afford to do that? Or are you looking at sort of staggered payments over time, regular gifts I mentioned earlier on? And you need to be careful to make sure that you don't breach certain timing rules. So if it's an inheritance tax efficient strategy you're looking at, for example, there is a thing called the 7-year rule that says if someone dies within 7 years of making a gift, a potentially exempt transfer, there may be an inheritance tax liability because that gift may bounce back into the deceased person's death estate and be taxed there. So in other words, thinking about who's going to benefit and when may have additional requirements and rules that need to be met, so be a little bit careful there. And that brings me on to tax. All right, if you make a gift, watch out for capital gains tax, because even if you think, well, I'm gifting property or shares, for argument's sake, at no price to the recipient, no sales proceeds, HMRC can take the view that actually there are deemed proceeds, as they're called, and there may be a capital gains tax implication. Not with pure cash, but it can arise, for example, if you give something like a property, and it can create an immediate obligation on the donor, as they're called. And again, for inheritance tax, make sure you're doing things tax efficiently, and generally speaking, that means make sure you pass all the affordability tests, make sure you're doing it in sufficient time to not get caught out by, say, the 7-year rule. And do consider the tax impact on the recipient. In other words, are there any tax implications on the person? Could be a child or a minor receiving the gift now or in the future. Are there any ways that, via trusts, for example, you could mitigate that or restructure it? Okay, lots of information there on the most effective way to make a financial gift. I've skimmed over what is a very big topic in practice. So for more information on the education side of things, then you can go to our new website, or you can email me, editor@killick.com. In both cases, you might be looking for one of these guides. There is a tax effective saving guide. The one next to me is called How to Invest in Equities. And there's also our quarterly flagship magazine, Confidant.